So you wanna go to war with me? You're talking like you think you're royalty. You think that I'm afraid, but I don't break. I heard you question my stability. You think I'll fall just like a guillotine, but I am here to stay. Won't look away. The storm is coming, so you better start running. No, you can't control, feel it in my bones. I'm coming for the, coming for the.
All right, guys, good afternoon. Happy Wednesday, March 20th. Welcome, welcome. The Fed press conference will be starting here momentarily. We're going to be listening in. We can chat in the chat while Mr. Powell is speaking. Sandra Gutt, good afternoon. The headlines from the press release, which came at the top of the hour, is that the Fed is going to hold rates steady, and they maintain their guidance that 3 more cuts will be coming sometime this year. We should be getting started here in just a moment with Mr. Powell in front of the reporters with their questions. Blazin', what's up, amigo? The bullet points go on to say that following the 2-day meeting, which ended today, Central Bank's rate setting committee said it will keep the benchmark overnight borrowing rate in a range between 5.25% and 5.5%. We don't want December 13th. Let me get the right one here. March 20th. Here we go.
But inflation is still too high. Ongoing progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. GDP growth in the fourth quarter of last year came in at 3.2%. For 2023 as a whole, GDP expanded 3.1%, bolstered by strong consumer demand as well as improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have weighed on business fixed investment. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2% over the next 2 years. Participants generally revised up their growth projections since December, reflecting the strength of incoming data, including data on labor supply. The labor market remains relatively tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 265,000 jobs per month. The unemployment rate has edged up but remains low at 3.9%. Strong job creation has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years, and a continued strong pace of immigration. Nominal wage growth has been easing and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressure on inflation. The median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.1% at the end of next year. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as from measures from financial markets. The median projection in the SEP for total PCE inflation falls to 2.4% this year, 2.2% next year, and 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are coming into better balance. We believe that our policy rate is likely at its peak for this tightening cycle, and that, if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably down toward 2%. Of course, we're committed to both sides of our dual mandate, and an unexpected weakening in the labor market could also warrant a policy response. We will continue to make our decisions meeting by meeting. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 4.6% at the end of this year, 3.9% at the end of 2025, and 3.1% at the end of 2026, still above the median longer-term funds rate. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. Turning to our balance sheet, our securities holdings have declined by nearly $1.5 trillion since the committee began reducing our portfolio. At this meeting, we discussed issues related to slowing the pace of decline in our securities holdings. While we did not make any decisions today on this, the general sense of the committee is that it will be appropriate to slow the pace of runoff fairly soon, consistent with the plans we previously issued. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach that ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping our longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and price stability over the long term. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you.
Thank you. Microphone, right. Steve Leisman, CNBC. Mr. Chairman, the projections show somewhat higher core inflation. They also show somewhat stronger growth. What should we infer from this notion that on average rates were kept the same this year, but inflation is higher and growth is higher? Does it mean more tolerance for higher inflation and less of a willingness to slow the economy to achieve that target?
Well, it doesn't. No, it doesn't mean that. What it means is that we've seen incoming, as I pointed out in my opening remarks, we did mark up our growth forecast, and so have many other forecasters. So the economy is performing well. And the inflation data came in a little bit higher as a separate matter, and I think that caused people to write up their inflation. But nonetheless, we continue to make good progress on bringing inflation down. And so...
When you just to follow up, when you say that you're willing to either maintain the rate for longer, what is the tolerance of the Federal Reserve for inflation coming in above its 2% target?
We're strongly committed to bringing inflation down to 2% over time. That is our goal, and we will achieve that goal. Markets believe we will achieve that goal, and they should believe that, because that's what will happen over time. But we stress over time, and so. I think we're making projections that do show that happening, and we're committed to that outcome, and we will bring it about.
Rachel. Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. You and others have been saying that relief on housing inflation is coming, but it still hasn't shown up meaningfully in the CPI or the PCE. Does that challenge your assumption about when the shift will finally break through, since it hasn't at that point?
So I think there's some confidence that the market rents, lower market rent increases that we're seeing will show up in measures of housing services inflation over time. There's a little bit of uncertainty about when that will happen, but there's real confidence that they will show up eventually over time. But again, uncertainty about the exact timing of that.
And will you be able to get overall inflation down to target if housing doesn't break through quickly, and does that affect the timing for eventual cuts this year?
We will get aggregate inflation down to 2% over time. We will. And I would assume that what we'll continue to see is we'll see goods prices coming into a new equilibrium where they're going down perhaps not as quickly as they had been earlier this year, where housing services inflation will come back down as current market rents are suggesting will happen, and where non-housing services will move back down. Some combination of those three things, and it may be different from the combination we had before the pandemic, will be achieved and will bring inflation back down to 2% sustainably.
Nick Timmeros of the Wall Street Journal. Chair Powell, during your congressional testimony this month, you said that your test for making the first change to interest rates does not require you to be terribly comfortable that inflation is at 2% because interest rates are well above neutral. At the same time, you said here after the last meeting that the first cut is highly consequential. Can you reconcile these views for me? If rates are well above neutral, why would the first cut be highly consequential? Is that because you anticipate one cut would be followed by one or two more along the lines of the recalibration you made in 2019, which itself was modeled on the mid-cycle adjustment of 1995?
It's more, I would put it more in the context of what I said in my opening remarks, that the risks are really two-sided here. We're in a situation where, if we ease too much or too soon, we could see inflation come back. And if we ease too late, we could do unnecessary harm to employment and people's working lives. And so we do see the risks as two-sided, so it is consequential. We want to be careful. And fortunately, with the economy growing, with the labor market strong, and with inflation coming down, we can approach that question carefully and let the data speak on that. That's really what I was thinking.
How much of that inflation that we've seen so far this year do you chalk up to one-off calendar adjustment effects following a period of high inflation versus some change in the trend we saw in the second half of last year?
I want to start by saying I always try to be careful about dismissing data that we don't like. So you need to check yourself on that, and I'll do that. But I would say the January number, which was very high, the January CPI and PCE numbers were quite high. There's reason to think that there could be seasonal effects there. But nonetheless, we don't want to be completely dismissive of it. The February number was higher than expectations, but we have it at currently well below 30 basis points core PCE, which is not terribly high. So it's not like the January number. But I take the two of them together, and I think they haven't really changed the overall story, which is that of inflation moving down gradually on a sometimes bumpy road toward 2%. I don't think that story has changed. I also don't think that those readings added to anyone's confidence that we're moving closer to that point. But we didn't. Last thing I'll say is we didn't excessively celebrate the good inflation readings we got in the last 7 months of last year. We didn't take too much signal out of that. What you heard us saying was that we needed to see more, that we could, we wanted to be careful about that decision, and we're not going to overreact as well to these 2 months of data, nor are we going to ignore them.
Hi, yes, Chair Powell. Could you speak a little bit more about the timing? Is there enough data between now and, say, May to be able to get the kind of confidence that you say that you still need, or by June, is there enough data for you? Just give us a sense of your thinking there. Thank you.
Yeah, so we make decisions meeting by meeting, and we didn't make any decisions about future meetings today. Those are going to depend on our ongoing assessment of the incoming data, the evolving outlook, and the balance of risk. So I really don't have anything for you on any specific meeting looking forward.
But just a question of, is there even enough data for you to be able to?
We'll take, things can happen during an intermeeting period if you look back, unexpected things. So I wouldn't want to dismiss anything. So I just would say that the committee wants to see more data that gives us higher confidence that inflation is moving down sustainably toward 2%. I also mentioned, and we don't see this in the data right now, but if there were a significant weakening in the data, particularly in the labor market, that could also be a reason for us to begin the process of reducing rates. Again, there's nothing in the data pointing at that, but those are the things that we'll be looking at coming meetings, and without trying to refer to any specific meeting.
Chris.
Hi, Chris Regaver at Associated Press. Thank you. In the projections, there is an increase in the neutral rate, as you know, and higher rates, a quarter point higher rates projected in 2025, 2026. Can you speak about what might be behind that? Is there a real sense here that the economy has perhaps changed in some way, that higher rates will be needed in the future? Thank you.
So you're right, they're pretty modest changes, but you're right, there was an uptick in the longer run rate, and also there's a 25 basis point increase in 25 and 26. In terms of are rates going to be higher in the longer run, if that's really your question, I don't think we know that. I think we think that rates were generally low during the pre-pandemic, post-global financial crisis era for reasons that are mostly, important, slow-moving, large things like demographics and productivity and that sort of thing, things that don't move quickly. But I don't think we know. My instinct would be that rates will not go back down to the very low levels that we saw, where all around the world there were long-run rates that were at or below zero in some cases. I don't see rates going back down to that level, but I think there's tremendous uncertainty around that.
Great. And just a quick follow on the projections, you also have 2.6% core inflation for the end of this year. It's already at, or you mentioned it being 2.8 in February. I mean, that doesn't sound like much disinflation at all. So are you still confident, or the last press conference you sounded pretty optimistic you would get more confidence till the end of this year. Is it right to say that this suggests you're not seeing a lot of disinflation this year compared to what we've seen 2023 and so forth?
I think that higher year-end number reflects the data we've seen so far this year, because you're now in this year. So I think that. Sorry, say your last part of your question again.
Well, just are you still optimistic that you'll get the confidence you need this year?
I think if you look at the SEP, what it says is that it is still likely in most people's view that we will achieve that confidence and that there will be rate cuts. But that's really going to depend on the incoming data. It is. The other thing is, in the second half of the year, you have some pretty low readings, so it might be harder to make progress as you move that 12-month window forward. Nonetheless, we're looking for data that confirm the kind of low readings that we had last year and give us a higher degree of confidence that what we saw was really inflation moving sustainably down to 2%, toward 2%.
Gina Smilik, The New York Times. Thank you for taking our questions. Per your comment, Anne, that a weakening in the labor market would be a reason to potentially cut rates, or at least a consideration in making a rate cut, would continued strength in the labor market be a reason to hold off on rate cuts? And just in general, if labor supply continued to rebound in 2024 the way it did in 2023, what would stronger hiring and possibly stronger growth mean for the path forward on policy?
Yeah, so if what we're getting is a lot of supply and a lot of demand, and that supply is actually feeding demand because workers are getting paid and they're spending, and that's, what you would have is potentially kind of what you had last year, which is a bigger economy where inflationary pressures are not increasing. In fact, they were decreasing. So you can have that if you have the continued supply side activity that we had last year, with both with supply chains and also with growth in the size of the labor force.
But so strong hiring in and of itself would not be a reason to hold off on rate cuts?
No, not all by itself, no. I mean, we saw, you saw last year, very strong hiring and inflation coming down quickly. We now have a better sense that a big part of that was supply side healing, particularly with growth in the labor force. So in and of itself, strong job growth is not a reason, for us to be concerned about inflation.
Neil.
Hi, Chair Powell. Neil Irwin with Axios. How do you assess the state of financial conditions right now, and in particular, do you view the kind of easing in financial conditions since the fall as consistent and compatible with what you're trying to achieve on the inflation mandate?
So we think there are many different financial conditions indicators, and you can kind of, see different answers to that question. But ultimately, we do think that financial conditions are weighing on economic activity, and we think you see that in a great place to see it is in the labor market, where you've seen demand cooling off a little bit from the extremely high levels. And there I would point to job openings, quits, surveys, the hiring rate, things like that are really demand. There are also supply side things happening, but I think those are demand side things happening. We saw, that's been a question for a while. We did see progress on inflation last year, significant progress, despite, financial conditions sometimes being tighter, sometimes looser.
Michael McGee with Bloomberg Radio and Television. Can you give us more color on how the committee is thinking about inflation dynamics now? What we've seen at the beginning of the year, are they more one-off increases that will fade, or is there more of a secular turn with goods prices rising again and service prices staying sticky? And also, housing prices have been sort of the Godot of this cycle, in that you keep expecting them to go down and they don't. How does the committee see this playing out forward since you've raised your inflation forecast?
So I see the committees looking at the 2 months of data and asking the same question you're asking and saying we're just going to have to see what the data show. As I mentioned, you can look at January, which is very high reading, and you can, and I think many people did see the possibility of seasonal adjustment problems there. But again, you got to be careful about dismissing the parts of the data that you don't like. So then February wasn't as high, but it was higher. So the question is, what are we going to see? We tend to see a little bit stronger, this is in the data, a little bit stronger inflation in the first half of the year, a little bit less strong later in the year. We're going to let the data show. I don't think we really know whether this is a bump on the road or something more. We'll have to find out. In the meantime, the economy is strong, the labor market is strong, inflation has come way down, and that gives us the ability to approach this question carefully and feel more confident that inflation is moving down sustainably to 2% when we take that step to begin dialing back our restrictive policy.
Well, you've talked about the desire to have confidence that inflation is continually moving down. Has the recent numbers we've gotten for inflation data dented that confidence at all?
It certainly hasn't improved our confidence. It hasn't raised anyone's confidence, but I would say that the story is really essentially the same, and that is of inflation coming down gradually toward 2% on a sometimes bumpy path, as I mentioned. I think that's what you still see. We've got 9 months of 2.5% inflation now, and we've had 2 months of kind of bumpy inflation. We were saying that it's going to be a bumpy ride. We consistently said that. Now here are some bumps, and the question is, are they more than bumps? And we can't know that. That's why we are approaching this question carefully. It is very important for everyone that we serve that we do get inflation sustainably down. And I think the historical record, every situation is different, but the historical record is that you need to approach that question carefully and try to get it right the first time and not have to come back and raise rates again, perhaps, if you cut inappropriately, prematurely.
Go to Edward.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, you received a letter from, the Federal Reserve, first independent body, understanding Congress has oversight over that. You received a letter from Senators Elizabeth Warren and Sheldon Whitehouse that said, calling on you to lower interest rates, to cut interest rates, because it says, quote, the potential that it may remain too high for too long has halted advances in deploying renewable energy technologies and delayed significant climate and economic benefits from these projects. So has higher interest rates caused that?
Have they? Well, first of all, I respect in our system of government, it is Congress that has oversight responsibility over the Fed. We place a tremendous amount of importance on our engagements with Congress and always treat them with great respect. In this case, I would say those are, our mandate. Our mandate is for maximum employment and price stability and the other things that we do. And that's what we're trying to accomplish. We're trying to do that in a way that sustains the strong growth we're seeing, the strong labor market we're seeing, but allows us to make further progress with inflation. That's how we can best serve the public and leave the other issues, which in many cases are incredibly important, such as those you mentioned, leave those to the people who have responsibility for those.
There was another letter from 24 lawmakers saying that the higher rates are squeezing the working people. How do these letters affect what you guys are doing policy-wise?
We receive these letters with respect, and we write careful responses and address concerns. We listen, again, because we're talking to the people who in our system of government have oversight over our activity. So but at the end of the day, we take that on board, but we have to make our judgments and we have to stick to our knitting, which is maximum employment, price stability, supervise and regulate the banks, work on the payment system, the things that we do.
Claire.
Thank you. Claire Jones, Financial Times. Thanks a lot for the opportunity to ask a question. As chair of the FOMC, would you want to see unanimity on the committee or something close to it, meaning no more than 1% before you begin cutting rates? Thank you.
We're a very consensus-oriented organization, and we do try to achieve consensus and ideally unanimity. People do dissent. It's something that happens. Life goes on, and it's not a problem. We've always had dissents, and so you respect thoughtful dissents very much. It's like you may not agree with some arguments, but you really want to understand them. So you may read a book that takes a position that you have long opposed, just to understand that book. So I treat dissents with real respect as well.
So Simon, what would you say?
Simon Urbanovich with The Economist. Can you hear me?
Yes.
Okay, great. Obviously, inflation is some ways away from target. Unemployment, though, if you look at the projection for the full year, 4.0%. In February, we were already at 3.9%, so quite close to the median projection. Are you concerned at all that, notwithstanding the very strong jobs growth, that in fact there may be some cracks appearing in the employment market? You talked about a significant deterioration in the labor market being a condition for easing rates. What would constitute that in your books? Thank you.
So we, of course, monitor it's one of our two goal variables. We all monitor the labor market very, very carefully, and I don't see those cracks today. And we follow all the possible stories that are out there about there being cracks. But the overall picture really is strong labor market. The extreme imbalances that we saw in the early parts of the pandemic recovery have mostly been resolved. You're seeing high job growth. You're seeing big increases in supply. You're seeing strong wage growth, but wage growth is gradually moderating down to more sustainable levels. In many, many respects, the things are returning more to their state in 2019, which we can think of as normal for this purpose. That's job openings and quits, and surveys of workers and businesses are always interesting on this. How easy is it to find a job? How easy it is to find a worker? Those surveys have both come down. So the labor market's in good shape. You do see things like the low hiring rate, and people have made the argument that if layoffs were to increase, that would mean that the net would be fairly quick increases in unemployment. So that's something we're watching, but we're not seeing it. Of course, initial claims are very, very low, and if anything, have tracked down a little bit. So watching it carefully, don't see it. And when I say something, I use the term unexpected weakening in the labor market. So, we do expect the unemployment rate to, the forecast is that it would move up, I think, closer to what we see as the longer run sustainable level. That's just people's forecast, individual forecasts. But we're talking about something that's unexpected. That's where I'll leave it, though.
Steve.
Steve Matthews with Bloomberg. You mentioned at the beginning of the press conference that the committee felt it might be appropriate to slow the pace of asset runoff fairly soon. I'm wondering, when you say fairly soon, does that mean that the committee would meet about this again in May and a decision could be reached that soon? And I was wondering if you could also just describe the scope of what the committee is discussing here. You're at $95 billion of caps right now. Would that be cut about in half or something in that nature? Thank you.
So that is what we're discussing essentially is and we're not discussing all the many other balance sheet issues. We will discuss those in due course. But what we're really looking at is slowing the pace of runoff. There isn't much runoff among MBS right now, but there is in treasuries, and we're talking about going to a lower pace. I don't want to give you a specific number because we haven't had an agreement or a decision, but that's the idea, that's what we're looking at. And in terms of the timing, I said fairly soon. I wouldn't want to try to be more specific than that, but you get the idea. The idea is, and this is in our longer run plans, that we may actually be able to get to a lower level because we would avoid the kind of frictions that can happen. Liquidity is not evenly distributed in the system, and there can be times when, in the aggregate, reserves are ample or even abundant, but not in every part. And those parts where they're not ample, there can be stress, and that can cause you to prematurely stop the process to avoid the stress, and then it would be very hard to restart, we think. So as something like that happened in 19, perhaps. So that's what we're doing. We're looking at what would be a good time and what would be a good structure. And, fairly soon is words that we use to mean fairly soon.
And will there be a discussion about returning to an all treasuries balance sheet at some point?
So that our longer run goal is to return to a balance sheet that is mostly treasuries. I do expect that once we're through this, we'll come back to the other issues about the composition and the maturity and revisit those issues. But it's not urgent right now. We want to get this decision made first, and then we can, when the time is right, come back to the other issues.
Victoria. Hi, Victoria Guido with Politico. Also on the balance sheet, can you talk a little bit about how the outlook for the banking sector might impact your balance sheet plans? Do you worry that as deposits start to shrink that we could see more turbulence?
We'll be watching carefully, but one of the reasons we're slowing down, we will soon enough, fairly soon, I should say, slow down, is that we want to avoid any kind of turbulence. I wasn't thinking particularly about banking sector turbulence, but we had some indicators the last time. This is our second time in doing this, and I think we're going to be paying a lot of attention to the things that started to happen and that foreshadowed what eventually happened at the end of that tightening cycle, where we wound up in a short reserves situation, and we don't want to do that again. And I think now we have a better sense of what are the indicators. It wasn't so much in the banking system as it was around, for example, where federal funds is trading relative to the administered rates, and where secured rates are relative to the administered rates. Those sorts of things. We will always be watching the banking system for similar signs, though.
Well, is it also because you're not sure exactly how the reserve supply will react once the overnight reverse repo facility, drops nearer at zero?
I think we broadly think that once the overnight repo stabilizes either at zero or close to zero, that as the balance sheet shrinks, we should expect that reserves will decline pretty close to dollar for dollar with that. That's what we think.
Go to Jean.
Hi, Chair Powell. Jean Young with M&I Market News. I wanted to ask also about the balance sheet. Will you said that starting the taper sooner could get you to a smaller balance sheet size. Does that mean you don't have to make a decision on when to end QT at this point? And will you be setting up the process for deciding that sooner, or will you wait until we're close to the end?
So it's sort of ironic that by going slower you can get farther, but that's the idea. The idea is that with a smoother transition, you'll run much less risk of kind of liquidity problems, which can grow into shocks and which can cause you to stop the process prematurely. So that's where, in terms of how it ends, we're going to be monitoring carefully money market conditions and asking ourselves what they're telling us about reserves. Right now we would characterize them as abundant, and what we're aiming for is ample, and which is a little bit less than abundant, right? So there isn't there's not a dollar amount or a percent of GDP or anything like that where we think we have a really pretty clear understanding of that. We're going to be looking at what these what's happening in money markets, in particular a bunch of different indicators, including the ones I mentioned, to tell us when we're getting close. Then, though, you reach a point ultimately where you stop allowing the balance sheet to run off, but then from that point, there's another period in which non-reserve liabilities grow organically, like currency, and that also shrinks the reserves at a very slow pace. So you have a slower pace of runoff, which we'll have fairly soon. Then you have another time where you effectively hold the balance sheet constant and allow non-reserve liabilities to expand, and then that ultimately brings you ideally in for, brings it into a nice easy landing at a level that is above what we think the lowest possible ample number would be. We're not trying for that. We want to have a cushion, a buffer, because we know that demand for reserves can be very volatile. And we don't want to, again, find ourselves in a situation where there aren't reserves. We have to turn around and, buy assets and put reserves back in the banking system the way we did in 2019-20.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, you said you're waiting to become more confident that inflation is getting to your 2% goal before you cut rates. Can you just sum up more specifically what data you're looking at that would give you that confidence?
Sure. So most importantly, we're looking at the incoming inflation data and the contents of it and what they're telling us. So that'll be, and also the various components. So obviously that's what we want. We want more confidence that inflation is coming down sustainably toward 2%. And I mean, of course, we'll also be looking at all the other things that are happening in the economy. We'll look at the totality of the data, including everything essentially, as we make that assessment. But the most important thing will be the inflation data that's coming in.
Well, are there things that you would give more weight to, like wages?
Wages is one thing. We don't. Our target is not wages. It's really inflation. We would look to the fact that wages are still coming in very strong, but they've been wage increases. That is to say, wage increases have been quite strong, but they're gradually coming down to levels that are more sustainable over time, and that's what we want. We don't think that the inflation was not originally caused, I don't think, mostly by wages. That wasn't really the story. But we do think that to get inflation back down to 2% sustainably, we'd like to see, continuing gradual movement of wage increases at still high levels, but back down to levels that are more sustainable over time.
Go to Greg.
Thank you. Greg Robb from MarketWatch. Chair Powell, could you say at this meeting whether there were more officials who wanted to be careful and go slower about rates than were at the last meeting? Was there that sense of maybe it's smart to wait? Thanks.
I guess I'd put it this way. If you look at the incoming inflation data that we've had for January and February, I think very broadly that suggests that we were right to wait until we're more confident. So I think I didn't hear anyone dismissing it as not information that we should look at or anything like that. So I think generally speaking, it does go in the direction of saying yes, it's appropriate for us to be careful as we approach this question.
Brendan.
Thanks, Chair Powell. Brendan Peterson with Punchbowl News. I wanted to ask you about central bank digital currency stuff. We've been hearing a lot from Republicans in Congress about what the Fed is or isn't doing in a digital dollar. But folks, I know you have said to Congress that you are going to wait for approval before the Fed does anything, launches anything. But folks like House Majority Whip Tom Emmer have said that the Fed is either actively researching or hiring personnel to study the implications of the CBDC. Can you give us any clarity on what the Fed is doing right now on a digital dollar?
Sure. So I think we've been pretty transparent on this, but I'll try harder. So we are not getting ready to, we haven't proposed, we haven't come to a conclusion that we should propose or anything like that, that Congress consider legislation to authorize a digital dollar. And it would take legislation by Congress signed by the president to give us the ability to do what we think of as a CBDC, which is really a retail CBDC with the public of it. So we're just a long, long way from that. What we are doing, and I think what every major central bank is doing, is we're trying to stay in the frontiers of what's going on in digital finance. And it has many, many different areas. It has applications in wholesale finance, in the payment system. And so we to serve the public, these issues have become very front burner in the last 5 or 6 years. We need to be knowledgeable about all that. So we actually do have people trying to understand things that are, but it's wrong to say that we're working on a CBDC and then we've secretly got a lab here where we've got one and we're just going to spring it on Congress at the right moment. We don't. I haven't at all in my own mind made a decision that I think this is something the U.S. should be doing. I just think it's something we need to understand, and we do have people who are keeping up with that as part of the broader payments landscape. That's how I would characterize it.
Mark.
Thank you. It's Mark Hamrick with Bankrate. Mr. Chairman, April 27th will mark the 13th anniversary since a Fed chairman began holding regular news conferences. How important has that higher transparency been in your view, both for the proper functioning of the central bank and also in accomplishing your mission? And is there more that you and your colleagues can do on the transparency front, and what might that look like?
I generally think this movement actually started, 30 years ago, when some academics posited that a more transparent central bank, if the public understands your reaction function, the markets will do your work for you. They'll react to the data. And so it all happens that way. And so there's been a march toward greater and greater transparency. And that certainly Chairman Bernanke advanced that. So Chairman Greenspan did, Chair Yellen did. And so we went from four press conferences a year to 8. So now every meeting really is live now. I think that's a good innovation. I wouldn't want to turn it back. We also have done a bunch of other things. We have an annual supervision report, financial stability report. There's a long list of things that we've done. I think nothing comes to mind as really desperately in need of doing at this moment. We're very transparent. We have no shortage of FOMC participants speaking to the public through the media. And so that channel is full, I would say. So I think it's generally broadly helped and made things better, but not every day and in every way.
Well, to follow up, has there ever been a day where you wanted to put that genie back in the bottle somewhat?
Of course not.
Let's go to Jennifer for the last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. Not to harp too much more on confidence and inflation, but you did say earlier in this press conference that the recent inflation data hasn't raised anyone's confidence. But when you testified before the Senate a couple weeks ago, you told lawmakers that you are, quote, not far from receiving the confidence needed on inflation to begin cutting rates. So are you still of that belief or not? What are we to take by those words, not far?
So let me say my main message at that in those 2 days of hearings was really that the committee needs to see more evidence to build our confidence that inflation is moving down sustainably toward our 2% goal. And we don't expect that it will be appropriate to begin to reduce rates until we're more confident that that is the case. I said that any number of times, so those were kind of the main part of the message. We repeated that today in our statement. I also, to the language you mentioned, I really pointed out that we had made significant progress over the past year, and what we're looking for now is confirmation that that progress will continue. We had a series of inflation readings over the second half of last year that were really much lower. We didn't overreact, as I mentioned, but that's what I had in mind.
But given that you said that PCE for February, 2.8%, the estimate, and that we have been seeing core PCE coming down by 10% every month, wouldn't you be at about 2.4% this summer, June, July, to a point where you could cut then?
Well, we'll just have to see how the data come in. We would, of course, love to get great inflation data. We got really good inflation data on the second part of last year. Again, we didn't overreact to it. We said we needed to see more, and we said it would be bumpy. And now we have January and February, which I've talked about a couple of times. So, we're looking for more good data, and we would certainly welcome it.
Thank you.
Thank you.
Thank you.
All right, yeah, Blazin said earlier, it's funny how a lot of these meetings seem a very similar format. He makes a statement, they try and ask questions to probe for more details, and he basically says, well, according to what I just said, and then he repeats what he just said. Fed, if you're just joining in, held rates steady at this meeting, and they said that they could foresee up to 3 more quarter point cuts later this year, but they're being very methodical and data driven. So things could change, but that is the current plan. And I'll go ahead and take a couple of other questions while I'm still here. Michael Anthony, good afternoon to you. Michael says, where you been? I'm still here, Michael. For those in the Discord, especially those that are joining in the voice chats, we start early every morning here, about 6 a.m. and I'm typically up working till 9 or 10 o'clock at night. So I'm still here watching AMC, GameStop, Nvidia, Bitcoin, all the stocks that people are talking about. But it's mostly not worth my time dealing with all the emotional crybabies on YouTube. So I'm focusing on people that actually want real information. And every weekend we kind of lay out our plan for the week, and every Monday morning we start executing on that plan. Sometimes, like this Monday, we wait a couple days. I've been putting in a lot of hours doing research and forecasting, and along those lines, I did just publish my current estimate for AMC's Q1 cash burn. So I've already forecast what AMC is going to make for net income or net loss for the year. For Q1, and then I extrapolate that into expected cash burn for those of you that are like I am, keeping an eye on what is AMC's cash position going to be quarter by quarter as we go through this year. Why do we care about that? Because we're trying to assess dilution risk. That for many of us that are not wanting to get caught by surprise by another dilution announcement. I don't know if one's going to happen, but it's definitely something that many of us are keeping an eye on. So go check that out if you're in the Discord. Discord's free for any member of the channel. Not subscriber, a member. So you have to hit the join button. If you are in the Discord and you don't have access to the AMC room, then you just need to send me a DM in Discord and we'll have a 5-minute phone conversation so I can make sure you're not a spam bot, and we'll get you set up. Ivan says, even if there is dilution, no one's selling. That might be true, Michael. Sorry, Ivan, at this point for many investors, but there are some of us that would expect that, again, if there's, depending on the size of a dilution, that it could have some negative impact to the price. And like myself, my cost average on AMC right now is at or near the current price, and I don't want to take a 20 or 30% hit. So if I suspect that there's going to be dilution, I'll step out for a week or two and avoid a rundown in that part of my portfolio, and then jump back in. That's why we're tracking it. For those that are already down 90%, it might not matter. BK Broiler says, will small caps start to move with this outlook, or will it require an actual cut? I would think, just my gut feeling, it's going to require an actual cut, or 2 or 3. You can see from the tickers we have up on the screen, I've got NVIDIA, AMC, GameStop, and the SPY. Everything's kind of moving index-based. It's a broad broad movement where everything's moving the same way. Let's check a few other blue chips and see how they look while we're here. I would expect that they all look about the same. AMD, just like the index. American Express, looking good. Citigroup, same. Caterpillar, bumping up. Costco. CVS. The Google. Home Depot. Coke, yeah, everything's just following the index. Broad rally today. We'll have to see if that holds into tomorrow and Friday. Blazin says, plenty of people have selling. I've sold multiple times and bought back in. Many people I know either did the same or just moved on completely. Yeah, I talk to many people every day, Ivan, that are selling or that are trading and not wanting to see further erosion in their positions. So let's not make broad generalizations, but I do agree with you that for those that held all the way through since August, that perhaps those people are not going to do anything. Most of the discussions we have in my Discord are how not to get obliterated, how to actively manage your trading strategy so you can profit. You know, there are ways to do it, but sometimes you have to let go of the old mentality. I don't make any judgment on whatever anybody wants to do. As you guys know, for AMC, I'm more long-term bullish into 2025, and I've stated that 2024 is going to be a sideways year for this company due to the box office, unless we get some surprise movies. So in a sideways year where I expect the company is going to lose money due to not being over 10.1, 10.5 billion box office, if I know that they're going to lose money, then I've got to pay attention to their cash burn and do my best for myself to anticipate, is there a risk of dilution? Because I'm walking a line right now where I'm positioned well if it runs up a couple dollars, but I don't want to take a 20 or 30% hit if he announces more dilution, if they get worried about their cash. At the end of the day, companies are going to do what they got to do to survive, and this company does not want to go bankrupt. They want to make sure they have enough liquidity to survive through the year. $880 million they got right now. That's plenty enough to get through the year. But I don't know what their pain point is where they say, it's getting a little close here. So that's the main thing I'm keeping an eye on for this year. Cash position, cash burn. Not because I'm worried about them going bankrupt. I'm not worried about that. Only because I'm worried about another dilution announcement. Broke Ape says, Just YOLO. Yeah, I don't know about that, broke ape. I have as I've always had, a conservative position in this play because it's a speculative stock. And I say that about any company you're invested in that is not profitable. You got to call it speculation, not investment. We invest in companies that have profits and a long history of growing revenues. AMC is in the growing revenue category, but they're not quite profitable yet. So it's still speculative. For me, that means I don't load the boat. I don't move all my portfolio into one stock. And I keep very close tabs on what's going on. I think there's plenty of opportunity if you're nimble, if you're not plugged into the wrong. I don't know the nice way to say it. If you're acting like a trader, there's plenty of opportunities in both GameStop and AMC. Civil War movie is something that I have maybe some high hopes. I think it comes out April 12th. It's getting very good reviews. That might be a sleeper hit. Should have some broad appeal. We'll see. That's my next best hope for a surprise upside on movies. Other than that, I'm kind of waiting for Q3. Blazing, he's reading my mind here. He's asked, will Q3, Q4 be better than this previous Q4 and Q1 we're in now on cash burn? So Q4 had a cash burn. Q1 is going to be worse by my estimation. I'm looking at box office coming in domestic for Q1, the one we're in now, about 1.5 to 1.6 billion. So the cash burn will be worse in Q1. And I anticipate that Q3 is when it starts getting better, Blazin. Let's see, what other fun little topics have been going on out there? I posted something out there on Twitter because I still see these little yappers. Adam Aarons and the board are trying to bankrupt the company. If you don't follow me on Twitter, or if you haven't checked my community tab here on YouTube, I've been going back and reading through a lot of old information over the past week. And so I posted a Q2 2020 AMC press release that showed 14 data points, 14 bullets of things they actively did back in the middle of 2020 to avoid bankruptcy. So I would ask you to go read that in the community tab here on YouTube. It's a photo, or on my recent Twitter post yesterday. And then someone said, okay, well, all right. Well, I can't argue with you there. They did a lot to avoid bankruptcy in 2020. But what are they doing today? What are they doing now to avoid bankruptcy? So I listed another 8 bullet points. Not my opinion, taken straight out of the most recent earnings call. 8 bullet points of what they are actively doing to avoid bankruptcy. And yeah, the other unspoken thing that we all know about is they will raise cash. They might dilute to what? To hurt you? To punish you? No, to avoid bankruptcy. It's up to you to read the fucking tea leaves and understand that this company is not trying to go bankrupt, and they might dilute more if they're worried about their cash. That's them fighting for survival. It's not to punish you. You're punishing yourself if you're standing in front of a Gatling gun and not moving. That's on us, guys. We make our own decisions. You know what the company has said every quarter, what they're trying to do: fix the balance sheet. Understand what that means. We've been talking about it here now for going on almost 2 years, that their strategic objective is to fix the balance sheet. Understand what that means. You can stand in front of the Gatling gun, or you can step aside and jump in and out, dodge those bullets. That's up to you. I don't care what you do. What else? Someone sent me a message and said, why were you against reverse split back in January of 2022 and when New York Angelo and other retail investors were clamoring for a reverse split? Do y'all remember that back in late 2021, early 2022, when people were saying, this was retail investors, not the company, saying we should do a reverse split? They're trying to come up with gimmicks to cause a short squeeze, is what retail was trying to do back then in early 2022. AMC had over $1.6 billion on the balance sheet. There was no reason to do a reverse split other than a gimmick to attempt to cause a short squeeze, which was not going to work. So I was against it back then. I'm generally against reverse splits, period, or dilution. But at some point, as investors, when we're looking at a balance sheet and a company running low on cash, we can't ignore the obvious. Well, some people can and do and still are, and they're crying about it every day. Why did he dilute? Why did he do the reverse split? Take a look at the damn balance sheet. There's your answer. But you won't do that because it's easier for you just to cry and blame everybody else. At some point, it became necessary for AMC to raise more cash. And they telegraphed that many, many quarters in advance. What else? Oh, people ask, why the reverse split? Because they were out of shares. They were out of shares, and it was not likely that any of us were going to approve giving them more shares. So they did what in the mode of self-survival as a corporation, they took whatever steps they felt they needed to free up some more shares for themselves. That's called a reverse split. Again, it wasn't to punish you. It wasn't to hurt you. It wasn't to steal your shares. It was to ensure the corporation's survival. And we told you for the last 18 months that this was going to happen. I don't tell you how to trade. I don't tell you to buy or sell. I tell you what I think is most likely to happen. It's up to you to decide what you're going to do about that. You didn't have to stay in the play and endure that. I didn't. I stepped out for a couple weeks and then I bought back in. And I'm doing just fine. People say, well, couldn't he have done anything else? Couldn't he have got a loan to get some more cash? No. Can't get any more loans, guys. Couldn't he have sold some AMC minted Hycroft coins? Sell a $20 coin for $1,000 each, and surely 4 million of us would have bought those, and we could have paid off the debt. You're a fucking dreamer. You're a dreamer if you think 4 million people are going to buy a $20 coin for $1,000. No. Couldn't he have done a rights offering and issued more shares to us directly? Yeah, but he could have. But rights offerings sometimes are canceled because they don't have enough subscription to it. And AMC had a certain amount of money they needed to raise to bolster the balance sheet, to increase the liquidity. There's no guarantee in a rights offering that you'll get a full subscription from the investors. And then you have to cancel the rights offering. Plus, you got to explain what it is. Plus, it's still dilution. So I don't know why they didn't do it, but I can think of a lot of logical reasons why it was just easier to take the check from Antara and do it the way they did. Ask them. Ask the company why they didn't do it. Don't ask me. I don't talk to them. I don't fucking know. But I can think of a few logical reasons. It's complicated. It might not have been fully subscribed. And they needed money now. Yes, we're live, babe. You want to come join? All right, give me a few minutes. I'll help you out. We're going to wrap up here in about 15. Rumble. Someone saying Rumble's. I haven't looked at Rumble's short interest. I see you guys saying it's 40%. Someone asked me about DWAC last night too. And my response to them is DWAC going to have a short squeeze. My response is, what's the short interest? I think it's around 10 or 11% on DWAC. Rumble. Let's look at the daily. Nice little push up from $3 to $9, currently trading around 8. And I haven't looked at their financials lately, so that'd be the first place I'd start to see what is the good news coming. Are we betting on Donald Trump for Rumble and DWAC? Might be a good bet. But it's speculation, right? I saw Teddy Zane finally put out a video the other day, and I sent him a note. Teddy, if you happen to watch this, we should go on Rumble and do some Trump coverage. Maybe Massalorian will join in with us. I don't really care to do it on YouTube because of the whole censoring thing. But I enjoy talking about politics too. I just don't do it on this channel. Roblox Gamer says, are you in any cannabis stocks? I am not, but I talk with people every day, especially over the last week. We've been looking hard at ACB. I was in some cannabis stocks back in 2021, and I stepped out. But I have been looking at a few of them recently, and we have a few people that are playing them. I have not taken the plunge at the moment. But if I do get to a point where I think there's some reason for me to jump into it or some reason for me to talk to you guys about it, I'll put a video out on that. Matt says, how's Massalorian doing? I talked to him, yes, a couple weeks ago. He was back in the U.S., so he made it back. And he told me he was looking for a place to stay since he's been gone for several months, most of the summer. And once he got settled in, he was going to get his computer and all his equipment set back up, and then get back to making videos and doing live streams. And he told me at the time, I think I talked to him on a Monday, that he was expecting to be set up by Friday. And that was like 2 weeks ago. I'm trying not to bug him. But Johnny, if you're set up, reach out. Let's do a live stream. Let's hang out. Let's have a beer. Let's say hi to the folks. Ronald says Tilray 18% short, probably the safest cannabis stock. I've been looking back through, so I did some coverage on these stocks a couple years ago. I think Aurora Cannabis is the one that I did the deepest dive on. And I've been looking through, as I have free time, looking through their more recent financials. I haven't looked at Tilray. But it won't take me long to come back up to speed on those. What's the cryptos doing today? 65.6 on BTC. The other thing I've been paying a lot of attention to is GameStop. I do have a position in GameStop. Below, my cost basis is below the current price. With the additional purchase I did yesterday, I have very tempered expectations for GameStop. I'm just going to be straight with you. I know the bear case. I know the bull case. I know that they're widely apart. They're widely apart on GameStop. I don't know which one's going to be correct, but I'm playing it for a short-term swing trade. I think that this will be a pivotal quarter for GameStop. Whatever the results may be, one side is going to be shocked. And I hope it's not retail investors, but I can't tell you which one it's going to be. Bill says ACB will go bankrupt. They keep selling assets to stay afloat. Yeah, what I saw on the financials, on the quick overview I did of ACB the other day, was not as bullish as I remember looking deeply at ACB a couple years ago, and I thought, coming back to it in this past week, that I'd see vast improvement. You would expect, they were positioning themselves well. I didn't see vast improvement. So I think all these cannabis stocks are getting the publicity, the hope of legalizing marijuana again. And that's fine.
Thanks for going
a momentum
live.
trade.
Clinking beer mugs. Hope we keep the hot streak going.
Eight Fathers Man-Child, how you doing, friend? I have one Tall Boy Coors Light left in the fridge. I need to go buy some more. Maybe we can clink some beer mugs tonight. I would love to do that. Thank you for the support of the channel, my friend. Tilray's financials, I haven't looked into them, but maybe we can do that real quick while we have a couple more minutes here. Let's do a 5-minute review. Let me move a tab down here. So this is where I always start when I'm taking a fresh look at a company. I'll just start with a broad overview of the quarterly and annual financials. I'll take a quick look at what analysts are saying. And then depending on what I see, I will start doing a deeper dive if it justifies my time. And I'll read through whatever 10 Qs I missed because I want to go read the footnotes. So let's look real quick at income annually going up. Net income, not so hot. Shares outstanding have increased from 2016 to 23, tenfold almost. Balance sheet getting run down. Current assets, 773 million, liabilities, 432. So working capital is okay. We want this number on current assets higher than current liabilities. As far as total assets to total liabilities, we got 4.3 billion, versus 977 million. So that's fine. They have positive shareholders' equity. Let's zoom into a quarterly. If all of this is Greek to you, then go watch I did 3 videos of what I look for. What you need to look for in 5 minutes on an income statement, balance sheet, and cash flow. Just to get a quick lay of the land. You don't need to be a CPA, just a couple things. What is the trend of these things looking like? Do we have a potential winner, or are we just speculating? Quarterly basis, revenue, total gross revenue looks good. Operating income, all negative. Net income, I see they had a couple of positive quarters 3-4 years ago, but still struggling to book a positive net income. And the dilution continues. Negative operating margin, negative profit margins. I mean, all these companies have the same basic issues. It's just, if we're going to, so I'm just looking at these like, hey, maybe we got a momentum opportunity here. Nothing's screaming to me here, strong value buy to have a sure winner over the next 5 years. Balance sheet wise, I mean, they're not horrible, but income statement wise, we got some issues to look at. Analyst forecast 375. Average price target. How many analysts? 2 analysts. How recent are these forecasts? September 2023, April, very old forecast. So I just gotta throw these out and do my own forecast. I'm not going to go on an analyst forecast or an analyst price target from a year ago. I'm just not. And that's what you got to be careful when you see on social media people saying, but Tilray's got a $5 price target. Okay, but that was made in April of 2023. You can't use that anymore. You've got 4 quarters of numbers that have been published since then. So you could use that as a starting point, but you need to see what's changed since then. But momentum's on their side. So now we know the financials have their own set of issues. Then we say, okay, maybe it's a swing trade, maybe it's a momentum trade. Now you just get into just straight chart analysis. The daily, the 1 hour, the 5 minute, looking at your moving averages, the VWAP. And then it gets into a little bit of TA and chart reading. But knowing what I see on the financials, I would expect at some point, if things don't work out with the news people are expecting, that it's just going to retrace all the way back down. Unless there's legalization, and that changes the whole game. Blazin says, do I think GameStop moves a lot one way or the other? Here's the deal, what I think, Blazin, for GameStop. I think revenue, everybody's pretty certain of what revenue is going to come in at on GameStop. The raging debate is what is earnings going to come in at. So if the more pessimistic analysts are correct, then I think I can't tell you what's going to happen in a day or two of earnings or a week. But if the analysts are correct, then I see GameStop dropping to $10 or lower over the rest of this year. If the analysts are way off base, if they're too bearish, if Ryan Cohen tightened up the ship so much that the wildly optimistic forecasts are correct, then I would say, again, you could have some upward volatility for a couple days, but it will settle back in around this price. All of that being said is assuming that there's no other surprise announcements, like he made $500 million, trading NVIDIA, Ryan Cohen. I'm assuming that there's no announcements like that when I'm telling you my thoughts here. I'm assuming that there's no announcement about a major strategic shift or an acquisition. All of those are game changers. I'm just saying, based on what we know now, based on the fact there's no analyst call, I've got to assume a very cautionary stance for myself. And I'll take a little wager on it for a little temporary upside swing, and maybe I'll get lucky that it's better than I expect. And hey, I'll take it. But I'm not going to be sitting here going live every day telling you that it's going to $40. That's although it's in the realm of possibility, I don't think it's high probability. Blazin says, how much cash did AMC have before they diluted last time? It's hard to pick that out, Blazin, because there's been so many methods that they've been diluting, the debt for equity swaps and the straight share issuance. But let's pull up the balance sheet. They got to a low of $458 million at the middle of last year. And recall, if we look at the cash burn since that point, if they had not diluted, they'd have like $20 million right now, which would be bankruptcy. How do I know that? If I go to cash flow annual 2023, net cash flow. Oh, I can't do net cash flow because it has the share issuance in it. But we did the math. It was going to leave them with just a handful of dollars if they did not dilute. Gus says Tilray needs to take some steps, but far better than the other dumpster fire, like ACB and CGC. Yeah, I'm not gonna throw any of them under the bus. They all have their set of issues. They all are struggling for profitability, and I hope that one or more of them make it. It kind of reminds me of the smaller EV companies. I'm pulling for the little guy. I want to see them win. But they're all still struggling a bit. So just size your position according to the risk if you're playing those. And maybe we'll get lucky with some news about legalization. But that, you know, there was all that hype 3-4 years ago. And I played it for that momentum hype, and then I got out, and I haven't looked back. I might play it again now, but I haven't decided to do that yet. Blazin, that's a good point. Blazin says, so if the low in the middle of the year was 458 million, fair to say that anything for AMC below 500 million on the balance sheet is a danger zone. I spend a lot of time, Blazin, awake and asleep, trying to put myself in their shoes. Sean Goodman, the CFO, is the one driving this. Not Adam Aaron, not the board. Let's be very clear. This is the CFO's role. And we might have a CPA on maybe tonight if one's available and talk about this. I think there's wide misunderstanding of who's driving the boat here in regards to decisions about dilution. It's not Adam Aaron, it's not the board. This Sean Goodman's job is to manage liquidity, to do the cash burn bridge, to forecast cash burn out 2 years. I've seen all the charts. You guys can go look at them. They're in the discovery documents from the Antara case. 900 pages, board meeting minutes. I know people call me crazy. Why do you spend your time reading that stuff? I'm looking for clues. I've been reading back through again these 900 pages. Spent many hours yesterday trying to get in the head of how this CFO is thinking. If you're wondering, how do I always seem to be able to predict what's going to happen? Because I spend a lot of time reading, analyzing, reading their words in the 10-Qs, reading these board meeting minute notes. And I've worked in corporate life. I know CFOs. In fact, well, let's not talk about that. I have friends that are CFOs in other companies, and I just try and think like them. I don't try and think like a retail investor or somebody who's not willing to look at the financials and be honest about what we got. All right, if we put all emotion aside and I'm just math analysis, what is the pain point? Like Blazin typed in his comment, what is the pain point where they get worried or the lenders start getting worried and applying pressure? That's what I think about. And figuring out that answer, Blazin, is our best shot. If we think it's getting to that point, some of us are going to step out for a couple weeks. But yeah, I spend a lot of time thinking about that. I don't want to step out of the play again. I own more shares now than I did before the reverse split. I don't want to step out. I'd like to be here for some good news. But if the cash gets burned off, I'm not going to stick my head in the sand and be blind to what's about to hit me smack upside the head. I'm not going to lose 20 or 30% by doing nothing. I will take action to manage my portfolio. That's just me. You do what you want. And we've laid out in the Discord with folks about 5 different strategies that you could implement depending on where you're at in the spectrum of I want to hold, I don't want to hold, I'm so far underwater I got to hold. We have about 5 different ways you could play this risk. And so I kind of have a recipe for everybody depending on where you're at. And then it's up to you to choose your path. As always, you're in charge of your portfolio, not me, not anybody on Twitter, not anybody on YouTube. Ariana says, I'm so glad we talk about more stocks now. Yeah, it's nice, Ariana, that there's not daily court cases and daily misinformation that we got to talk about on AMC. We're just kind of in a holding pattern, waiting for the box office to improve. And we need to check in. I'll probably do a quarterly update on cash burn, but in the Discord, I'm doing weekly updates on my forecast of the cash burn, because you really need more frequent updates, but most people aren't going to want to hear that information. They're going to say I'm being negative. You're being negative monitoring the cash burn. I'm being smart. Smooth operator, how you doing, friend? All right, I'll take one more question. We're at the top of the hour and my wife needs some help with a task. Forrest Gump Jr. says DEA will be talking about cannabis punishments Friday. Doubt it gets legalized anytime soon. I think the general consensus from the majority of people that I talk to, Mr. Gump, agrees with yourself. It's not likely to be legalized. However, that doesn't prevent people from talking it up and making it a potential momentum trade. You just got to be smart enough to read the chart and take some profits along the way, I think. Just a general reminder, friendly reminder. I don't talk to anybody at AMC, never have, other than shaking Adam Aaron's hand for about 5 seconds in Dallas, Texas, a couple years ago. All opinions are my own DD, my own work, my own hundreds and hundreds of hours of reading, researching, applying logic, applying math, applying finance. Nobody pays me. Nobody has ever paid me for any opinion or anything that I've said on this channel, despite all the crybabies saying otherwise. They live in their own little clown world, creating crazy little conspiracy theories in their heads. And we chuckle at them, and I feel sorry for them. But this is just, and always has been, me, raw and unfiltered. Love it or hate it, I don't care. I'm going to be as transparent as I can with you about what I see coming. And then you can use that information or discard it. That's up to you. I think tonight might be a good night maybe to do a live stream. So I'll reach out to a few people since it's been a while since we've done a live stream. And maybe just kick back and have a beer, smoke another cigar, talk about some more stocks. So I'm going to sign off for now. I'll reach out to a couple folks on DM and phone and see if we can assemble a little crew to talk about some things with you guys tonight. If you're around and if you're looking for something to do, come join us. Thank you to all the subscribers of the channel. Thank you to all the members of your channel for your support. Lots more to come, and we will see you on the next one.
So you wanna go to war with me? You're talking like you think you're royalty. You think that I'm afraid, but I don't break. I heard you question my stability. You think I'll fall just like a guillotine, but I am here to stay. Won't look away. The storm is coming, so you better start running. No, you can't control it anymore.